LoanDepot had a good day today, and it's up 121% year to date. Let's do a 1 minute discounted cash flow analysis of LoanDepot and see if there's still room to run on the stock. LoanDepot is a non bank U.S. mortgage lender. Business mix of consumer direct, retail loan offices, joint ventures, and a large servicing book. Servicing UPB of 117 billion, which is 418,000 customers, with a recapture rate of 70% versus the industry standard of 34%. In an IPO in 21, it peaked during the refi boom and then it crashed. It's now stabilizing now that rates are coming down. So in 21, it had 3.7 billion in revenue, 623 million in profit. 22 was the bust, 1.26 billion in revenue with 610 million dollars in losses. 23 was 973 million dollars of revenue with negative 236 million in losses. And you see things starting to turn around in 24 with about 1 billion in revenue with 9% growth and $202 million in losses, but the adjusted EBITDA was positive 84 million versus $6 million prior. And 25 revenues coming out at 274 million, 23% year-over-year growth with losses down to 41 million. So it's improved. Still losing money though. So Q2 where we stand, 283 million, up 3% quarter over quarter, losses of 25 million, but an adjusted EBITDA of 26 million and $409 million of cash in the bank. So the trend's in the right direction, break evens in sight. Cash 409 million, corporate debt 500 to 600 million after refinancing. Interest is about $44 million a year of servicing. Warehouse lines of 3.7 billion, capacity matched to loan volume. Equity book value is 460 million, price to books about 3 times. This is not a wide moat company as mortgages are commodities, but it has a strong brand, a digital platform called Mello, and a diversified channels direct with retail and joint ventures. It has a huge servicing portfolio with high recapture, and there's a flywheel effect. But the competition's fierce with Rocket and UMW being their main competitors. Here are my DCF valuation assumptions over 15-year horizon. Origination volume 2025 of 26 billion, up 15%. 2026, 31 billion, up 20%. 2030, approximately 50 billion. Then after that, I go to a 3% compound annual growth rate. I have the gain on sale margin growing from 3 to 3.25% base. Net margin rises to 5% by 2030 in the base case. In the bull case, we're going to say 10%. The servicing fee of a 0.25% of UPB annually tied to $117 billion portfolio growing slowly. I'm going to give this a 12% discount rate because it's a riskier company with a terminal growth of 2.5%. Now the key lever here is every 1% in sustainable net margin adds $1 to the share value. And it has a servicing book that puts a hard asset backstop of $5.50 a share, meaning theoretically they could sell that book and receive $5.50 per share.